In recent weeks, we've been following two big themes driving financial markets: monetary policy and natural gas. The outlook for US natural gas seems to get more positive every week. Meanwhile, the Fed is very slow in getting rates back to neutral, by more than a year in the opinion of many. Inflation expectations have been drifting up, but so far the market implied 10-year inflation rate is still below 3%. I think it'll wind up being higher, but the Fed can draw some comfort that it seems well behaved for now. The equity risk premium compares the earnings yield on stocks with the 10-year Treasury. Rising bond yields mean that stocks are at roughly their average relative valuation over the past couple of decades, and they're expensive compared looking over just the past 10 years. This doesn't necessarily mean they're a sale, but Bill Dudley, former New York Fed president, has said the Fed needs to get stocks lower as part of making overall financial conditions tighter. Although the Fed's no longer buying bonds, they're not selling either. $1 trillion will mature within the next year, but the roll-off of these short-term securities won't do much to push up 10-year yields, which is the part of the yield curve that needs to move higher in order to slow the economy. The Fed owns $2.5 trillion in mortgage-backed securities. They've been financing most of the new mortgages American homeowners have taken out in the past couple of years. That's helped create today's hot real estate market. It seems obvious that if quantitative easing, or QE, involved buying bonds, reversing this through quantitative tightening, or QT, should mean selling them. But that will present the Fed with a political problem because they'd have to book losses as they sold bonds that were originally bought at a higher price when yields were lower. Explaining to Congress why the Fed has lost money isn't something any Fed chair wants to do. So it's likely that the political expediency will tie their hands and prevent the Fed from pushing up long-term yields as much as they should. The Fed puts out forecasts of inflation, growth, interest rates, and other key metrics on the economy. The members of the Federal Open Market Committee are an incredibly optimistic bunch. They expect inflation to fall below 3% next year while unemployment barely moves, and they believe this painless outcome will come about with the Fed funds rate not even exceeding 3%. Bill Dudley and others think this perfect economic result will be very hard to achieve. Our bet is that inflation will come down, but not as quickly as this, and we'll all learn to live with inflation of 3 to 4%, not 2%. Energy stocks are one possible solution for investors in a world where inflation doesn't go back to the 2% level we had for so long. At SL Advisors, we invest in midstream energy infrastructure. That's pipelines, storage, and processing. We sit between the producers of oil and gas and the customers, which are often utilities, export terminals, or refineries. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. Turning to energy, midstream energy infrastructure is having a good year. The sector is up over 20% through April, bucking the trend of the broader equity averages, which is down. Natural gas stocks have been leading the way. Cheniere, the leading exporter of liquefied natural gas, or LNG, is a good example of how reduced capital spending is driving free cash flow higher. A few years ago, Cheniere was spending almost $5 billion a year building their LNG export facilities. Most of that work is done, and so their spending is down by 80%. Meanwhile, cash flow from operations is rising as their volumes increase, so now they're generating more cash from their business than in their investing. And they're likely to continue doing that for many years to come. Cheniere is a great example, but many other energy companies, both midstream and upstream, continue to focus on driving free cash flow higher. Cheniere exports almost half the LNG America sends abroad. Combined with pipeline exports to Mexico and Canada, we are becoming the world's biggest natural gas exporter. When it comes to energy independence, the simplest way to view it is to take the energy equivalent of all the energy we use and then look at the trade balance that way. 15 years ago, we used to import almost a third of the energy we used. Today, thanks to the shale revolution, we are a net energy exporter. Because of this and ongoing good financial performance, the energy sector is doing well. People often ask us if they've missed the move. It's true, pipeline stocks have performed very well in the past year, but they fell sharply 2 years ago. The longer-term performance is starting to look quite good too. Over the past 4 years, midstream energy infrastructure has done almost the same as the S&P 500. If you're thinking of making a portfolio allocation to stocks, past performance doesn't put you off. It should be the same with midstream energy. Going back to late 2010, the inception of our American Energy Independence Index shows that it's not far off the broader equity market averages over more than a decade too. Democrat policies have helped. Crude oil prices are higher than they were under Trump. That's true even after removing the drop in prices caused by COVID while Trump was in office and the jump in prices that Russia caused by invading Ukraine. Democrat policies raise energy prices. This has also been good for the sector. We manage investment products to profit from the outcomes I've discussed. To find out more about what we're thinking, sign up for our bi-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack with SL Advisors. Thank you for watching this video.